What is up, guys? Your agent Tyler Wayrong here, and I'm back with another video teaching you creative ways to go find money to use to hit any personal goal you might have, whether that's real estate investing, paying off debt, or just getting access to additional capital to open up doors in your life. So today, guys, we're going to be talking about the BLOC, or the business line of credit. We've talked ad nauseum about the HELOC here on this channel, and today I'm going to show you a different flavor of that, leveraging your business if you have one, and if you don't, we'll talk a little bit about that too. But guys, today is going to be all about the BLOC. So what is a business line of credit? So just like the home equity line of credit, where we're able to tap into the existing equity in our home, banks are also comfortable with lending against the business as the asset. So you put your business on the line as collateral, and the banks are willing to lend you a certain portion of that against that in the form of a line of credit where you can tap into to use for whatever you want, ideally to support your business. But as always on this channel, we're big into real estate, so we're going to talk about how you might do that in a real estate investor business. So before we dive in there, let's talk about what you might need to get this business line of credit off the ground. So if you couldn't tell already, this right here is a business. I didn't go to school for my art capabilities. You'll have to just use your creativity here, and I don't know why my business has smokestacks, but hey, that's what it is. One of the initial criteria here is that the business has been open for at least 2 years. So we often think about businesses as more of the brick and mortar style, but the 2-year mark actually goes back to the date your entity or your business was formed. Now, this is a little hard to prove if you're not a formal entity such as an LLC. If you're just doing business as yourself, that may get tricky, and you want to talk to a specific lender how they'll go about capturing that time requirement. Maybe it's tax returns, I'm not sure. But for most investors or real estate investors, you have an LLC that you're either running your rental properties through or flipping, whatever business you're using to do that. Once that LLC is formed for 2 years, at that time you can call to see what access you might be able to tap into for this business line of credit. Okay, so once you have been in business for the last 2 years, the way they determine the amount that you're able to get access to based on these last 2 years is looking at the gross profits from your last 2 years of whatever you're filing on your tax returns. So this is that eloquent balance where most investors invest in real estate to decrease their tax liability by showing really no profit in their business. But in this scenario, and I always tell people, in the first 2 to 3 years of business, you really want to show as much profit as you can if you're looking for additional lending opportunities, because they're going to be going off of your tax returns. And if you show a business that doesn't produce a profit, you may actually show the bank that you have a liability rather than a business that produces cash flow. So the way that most lenders do this is they look at your past 2 years tax returns and take the average of that, and then they're going to give you a percentage of that average in a liquid line of credit that you can use to then tap into. And so the lender that I specifically use, and I'll drop their contact below because they are a nationwide BLOC lender, and they actually use 20% of your 2 previous years' gross profits. So let's walk through a quick example here. So if we say that in the last 2 years you've done gross profits of $250,000 and $300,000, both in each year, the average between those two would be $275,000, and then you go ahead and take 20% of that. So 20% of $275,000 will give you $55,000 that they would be willing to give you this business line of credit against. Now you may be thinking, man, my rental business isn't going to generate that kind of top line revenue, and even if it did, I'm only getting access to $55,000. Well, here's a couple things to think through. The first being, yes, this probably isn't going to work great if you're just looking to use your rental business to try to kick one of these off. You're probably better off trying to get in a HELOC on an investment property. And if you are, check out this video up here where I talk about a specific lender that does provide products like that. But if you're more of an active real estate investor and you do a couple flips a year and they're going off your top line revenue, it doesn't take many flip houses being sold in this market to really increase that top line revenue number that you can use to then start to tap into a piece of that. Another thing that I found with this specific product is a lot of lenders have a minimum that they're willing to give you without doing any underwriting or really looking at your specific revenue numbers, and oftentimes I've found that to be roughly $50,000. So if you reach out and you just tell them a little bit about, hey, I'm in business for this many years, here are some tax returns, etc., there are several no underwriting business lines of credit out there up to $50,000. So Don't get too hung up on this revenue piece and just think if you're not in the several $100,000 a year top line revenue that you don't have an option here. Obviously, that should probably be a goal to increase that top line revenue unless you're in the rental business only, as that's a very unique business model, and this product is typically tailored toward traditional businesses that produce a product or a service. So you want to keep all that in mind, but also it wouldn't hurt to reach out and see what your options are based on where you are today. And what I've found from most of my research is that your business line of credit rate is going to be very close to what you're going to get on a home equity line of credit, which if you want to know all about how those rates are formed, check out this video up here. But typically it's going to be in the range of prime plus 1.5% to 2% depending on the specific lender and how the market's doing in general. So again, reach out and call if you think this may be available to you. And lastly, guys, anytime you're taking out a line of credit or taking on debt, there is a risk factor involved, and just like a HELOC ties that risk to your house, whereas the bank could go after your house. In this scenario, the bank is going to be able to go after your business and take over your business assets, and most of the time they're going to have you sign a personal guarantee that allows them to pierce the corporate veil, which basically means they can take everything from your business and also anything you personally own. Typically you create separate businesses to keep the liability separate, but when you sign a personal guarantee, you're allowing them to go right through that and go after all of your personal assets as well. So keep that in mind and never open one of these up unless you have a good plan to get it paid back quickly, and that this isn't long-term financing, but rather liquid cash that you only pay for when you use, so that you can take advantage of opportunities that are conducive for these types of situations. But guys, if you got any value out of today's video, a like or subscribe would be greatly appreciated. Those are all free ways to support the channel. Paid ways to support are super chats. You'll see those down below as well. But if there's something I didn't cover here and you want to know more, drop that in the comments below and I'd be happy to jump down there and answer all of those. But with that, guys, I'm Tyler Waverung, and we'll catch you.